EFA Institute's Private Wealth Committee. It's May 23rd, 2013, and I want to thank you for taking time to participate on this webinar, which is titled The Retirement Crisis, How to Achieve a Higher Safe Withdrawal Rate Using a Dynamic Withdrawal Strategy. In January of 2013, David Zolt authored an article in the Journal of Financial Planning titled Achieving a Higher Safe Withdrawal Rate with the Target Percentage Adjustment. I was fortunate to be one of Dave's sounding boards as he was writing the paper, and I also helped edit several versions before it was published. I think in the paper, Dave attributed any errors or omissions to me, and probably rightfully so. That's my little joke, sorry. In his presentation, David will review the research underpinnings of the 4% rule, address the current research, and illustrate examples of how his new concept of the target percentage adjustment is used to monitor portfolio safety and actions required to extend portfolio longevity. Dave has worked over 25 years in retirement and employee benefit planning as a senior fee-only advisor. He has worked for some of the major employee benefits consulting firms, including Buck Consultants, Foster Higgins, Mercer Consulting, and Coopers & Lybrand. His clients range from small to large organizations, including American Greetings, Ford Motor Company, the Catholic Diocese of Cleveland and Brooklyn, New York, the United Nations, World Bank, and the International Monetary Fund. Dave's position as a trusted fee-only advisor to some of the largest pools of liquid assets in the world gave him a rare opportunity to watch senior professionals advise how to invest multi-million and multi-billion-dollar pension funds. In the process, he learned firsthand how professionals invest and ultimately realize the wisdom of a long-term, low-cost buy-and-hold investment strategy. David is a certified financial planner, an enrolled agent, and a NAPFA-registered financial advisor. He currently provides fee-only comprehensive financial planning to individuals and families through his own company, Westlake Advisors, a registered investment advisor. Again, if everyone can please mute their lines and join me in welcoming Dave Zolt. Thanks, Dave.
Okay, thank you very much, Dave. Good afternoon, everybody. Today I'm going to show you how to increase your safe withdrawal rate by as much as 50% without increasing the risk of failure by using a new dynamic withdrawal strategy that I've developed called the target percentage adjustment. A little housekeeping first. If you don't follow something, feel free to interrupt and ask for clarification, but otherwise, please hold your questions till the end. If you're posing your questions through the chat feature, you can ask them anytime. My understanding is Dave will collect them and will address them at the end. Just a disclaimer to keep our compliance people happy. This information is educational and informational purposes only, and doesn't constitute professional, personalized investment or any other professional advice. Before I get into the target percentage, I want to go over a little bit of background history, the 4% rule. As a financial planner, the most important question my clients ask me is, how much can I withdraw from my portfolio and be sure I'm not going to outlive my money? It's not just an important question, it's also a difficult question because we really don't know the answer. To a certain degree, we're trying to predict the future. In 1994, Bill Bengen started off the answering this question for the field with an article in the Journal of Financial Planning that established the 4% rule as the gold standard in safe withdrawal rates. To put it in perspective, back then, with the go-go years of the 80s and 90s, people were not thinking in terms of safe withdrawal rates. They were thinking in terms of expected returns, and they were recommending much higher withdrawal rates for people going forward. So when Bengen came out with his article, it caused quite a stir because 4% seemed pretty low at that point. Recently, it's become quite a hot topic, and that's been bubbling up for a little while now. It probably started within the last 5 or 10 years. We've seen papers in the academic journals, and recently, in the last year or so, it's made it into the popular press in the New York Times and the Wall Street Journal. Over the years, some have argued 4% is too high, others have argued it's too low. As I said before, it's kind of gone from being too low. Now everybody's talk about it's being too high. There's been a lot of press about an article called "The 4% Rule is No Longer Safe in a Low Yield World," and I'll talk about that a little later. So for people who are not yet retired, don't think this doesn't apply to you, because the safe withdrawal rate defines how much you want to save to make retirement feasible. So, for example, if 4% is the safe withdrawal rate, then you want to save 25 times your annual living expenses to retire comfortably. If it's 5%, then that's 20 times your annual living expenses. Very big difference in the target.
Dave, I think we have somebody put you on mute. So everybody, please put your lines on mute and don't switch over to another line or put your line on hold. Thank you.
Okay, thanks. I'm going to give you the Reader's Digest version of Bengen's rule and methodology. One thing a lot of people don't realize, I'm surprised how many people don't realize that Bengen studied inflation-adjusted withdrawals. A lot of people think that the 4% rule just means you take 4% each year. That's not the way Bengen's studied the topic, and that's not the way all the papers that followed have studied the topic. Basically, they assume that 4% is the initial withdrawal rate, and that rate is increased by inflation each year. The CPI, kind of like Social Security, is increased, and the question is how long. What's the highest rate that will sustain over 30 years? So that's the question he set to answer in his article. He took the capital market data, standard data from Ibbotson at that time from 1926 to 1992. He looked at each consecutive 30-year period. So within that time frame, we've got 37 samples, 37 consecutive 30-year periods to test. He looked at a portfolio of 50% large cap, similar to the S&P 500, and 50% intermediate-term government bonds. He studied various withdrawal rates, 2, 3, 4, 5, and 6%, and he concluded that 4% was the highest rate to survive all consecutive periods. So you can see that 4% is not the average. A lot of people think in terms of averages and expected returns. 4% is the worst-case scenario. And a picture tells 1,000 words. So this is really kind of a summary of Bengen's study. So each of these, along the bottom, is your year of retirement, and each bar represents the highest initial withdrawal rate, inflation-adjusted for 30 years, that would sustain the withdrawal, sustain the portfolio successfully. So success means that after 30 years, you have at least $1 in your portfolio. So you can see that the shortest of these lines is around 1967, something around there. That just about hit 4%. Another shorty is in 1937. We'll talk about that a little later. Interestingly enough, if you look at 1982, you could have retired in 1982, taken about 9.5% of your portfolio in the first year, inflation adjusted it for 30 years, and your portfolio would have lasted for 30 years at that withdrawal rate. But the idea is that the average here is about 6%ish, so the point is that 4% is a worst-case scenario. Of all this is all the data we have. This is the universe, the sample that we have. It's from a statistical standpoint, it's a relatively small sample, but that's the data that we have. And again, that's looking forward. We don't know what the future is going to be. So if you watch the screen carefully, I'm going to shift the asset mix a little bit. Okay, what I just did was I changed from a 50% large cap to 35% large cap, 15% small cap. This is the portfolio I used for my study. It's very similar to the portfolio that Bengen used in his later work. And the reason I like it is because it's instead of using the S&P 500, it really kind of it's a closer approximation to maybe the total stock market. And as you can see, those bars jumped up a little bit. So by adding small caps, we gained just about 0.5% or something in that neighborhood. in our safe withdrawal rate. So now the shortest line is 1969, and I think that's 4.3%. And 1938 is another one that we'll talk about, and that's about 4.7 or so. Okay, now let's jump ahead to the current research. Basically, a lot of the researchers in the field they see a perfect storm ahead for safe withdrawal rates. And what they're looking at is low bond yields, which obviously suppress portfolio returns. They're saying high equity valuations, which I don't agree with, but that's what they're saying, and that's kind of another topic outside this webinar probably. And then there's sequence risk. Sequence risk means that the early retirement years are critical. If you have bad portfolio returns in the first few years of retirement, that's dangerous. That will peril your portfolio. And it really doesn't matter if you have great returns in the first years and lousy returns in the last years. Not a big deal. But it's those early years that'll get you. So as a result, some are very pessimistic about the future, others not so much. For example, this article that I mentioned at the beginning, the 4% is no longer safe in a low-yield environment. Basically, they're saying that a 4% withdrawal rate using their assumptions, which again I question, has about a 50% success rate. A 3% withdrawal rate has a 20 to 25% failure rate, or 75 to 80% success rate. But if we can get a consensus from the current researchers, forget about this disagreement on assumptions. I think there's a consensus that 4% may not be as safe as it once was. But more importantly, everybody's saying that planners and clients need to monitor their portfolio going forward and be prepared to reduce future withdrawals to sustain the long-term portfolio survivability using a dynamic withdrawal strategy. Used to be called an adaptive withdrawal strategy. Today they're calling it a dynamic withdrawal strategy, which basically means you don't just take that 4% inflation-adjusted withdrawal. You know, you have some flexibility. So how should clients respond to this? Is there a metric to monitor portfolio health? Well, I looked around and surveyed the world of financial planning, and I didn't find one. So I came up with the target percentage. That's, to me, that's my metric. And then what dynamic strategy should I use to adjust withdrawals going forward when the metric is breached? And that's the target percentage adjustment. And the way it works, it concentrates on inflation. Now, Bengen's model assumed a guaranteed annual inflation increases, and so even if your portfolio went south, you still took your CPI increases just like Social Security. And the vast majority of the research also uses this assumption in this framework. The concept is that it maintains your purchasing power, that the basket of goods that your withdrawal could buy in the initial year is throughout your period of retirement. Now, in contrast to that, there is some research that says on an inflation-adjusted basis, retirees' spending decreases with age, and that's typically in the later ages, 70s, 80s, 90s. If you want that research, it's referenced in my article. You could take a look at it there. So this table will set up the analytical framework that I'm going to use throughout the study. These are the results of some Monte Carlo simulations I prepared, and they're based on a 95% success rate. In other words, 95% chance that you'll that your portfolio will survive either 30, 35, or 40 years is what I used. Now, the blue section at the top here is Bengen's methodology. It assumes a full CPI increase, and over 30 years, I'm coming pretty close to Bengen's 4%. I get 3.9% is the 95% confidence level. So if you withdraw 3.9% inflation adjusted over 30 years, based on the same data Bengen used, except I'm using it in a Monte Carlo context, you have a 95% chance of success. and at the end of that period, your withdrawals over 30 years will be on an inflation-adjusted basis 100% of what you started with. So there's no loss in purchasing power. Now, the second set of numbers, the CPI minus 100, shows that CPI minus 1%, I'm sorry, shows if instead of taking the full CPI increase, you took 1% less than that, you could increase your initial withdrawal rate to 4.3%, which is a 10% increase in your withdrawal. That's quite substantial. And you will, but over 30 years, your 30th year withdrawal will be 81% of the basket of goods that the initial withdrawal could have bought, which is a 19% loss in purchasing power. And then 2% is down to you could increase your withdrawal rate from 20 to 24%, but with a 1/3 loss of purchasing power, and down to a full CPI, no CPI increases in the second to last row of numbers. You could go up to 6% initial withdrawal rate, still be 95% confident of being successful for 30 years, but you would have lost almost 2/3 of your purchasing power. So here's the concept of the target percent. What if you took inflation only in the good years, the inflation increase, skip or reduce the inflation increase in the bad years, based on some measure of portfolio health or survivability? Could you take higher withdrawals without increasing your probability of failure, which is running out of money? So here's the target percentage. This is a table right out of my paper, the idea is to build the last column, which is the last column is the target percentage. And the way I do that, and there's an infinite number of ways to build the target percentages, but the way I like to do it is you start with those three parameters at the top: your initial withdrawal rate, I'm using 4%, your inflation rate, I like to assume 3%, and your portfolio return. What I usually do is I solve for the portfolio return that gets me the time horizon that I'm looking for. In this particular table, I was using a 45-year time horizon. So 6.1% sustains the portfolio over 45 years. Now, I only put half the table on each slide because I wanted you to be able to read it. So this table goes up to 23 years, starts out with $1 million. It's withdraw 4% of that, which is 40,000. I'm assuming beginning of year withdrawals, so 6.1% interest on 960,000 is 58,560. In the next year, I start the year with 1,118,560, which is just the 960 plus the 58,560, and then I increase my withdrawal by 3%. I calculate the interest on the difference of the previous two columns, and then I roll forward. And it's just a roll forward of the projection of the portfolio. As you can see, the portfolio is expected to rise and then peak out right at about year 22 is when it starts on the decline. The target percentage starts out at 4% and climbs. So as you can see, it doesn't stay at 4%. By year 16, it's up to 5%. By year 23, it's up to 6%. Now we'll look at the latter half of the table. And you can see the portfolio declines to 0 eventually, and the withdrawal rate increases to 100%, and it's about 10%, about 11 years shy of the 45-year period. So that's basically how I build the target percentage. And you could build it any way. You can use any assumptions you want. You probably want to use the initial withdrawal rate that you're starting with, so it's aligned to your plan. So what is the target percentage? The target percentage is a glide path for your withdrawal rate throughout retirement. It's a benchmark for your success or failure. And the nice thing about it is it automatically adjusts for experience from all factors. So it's a single metric that flexes, that takes into account all these factors in the aggregate, whether it's portfolio return, inflation, or even strange variations in your withdrawals, like a one-time large expenditure. So it's always ready to use, and you don't have to think about all those other factors. Okay, the target percentage adjustment. Okay, that the target percentage adjustment is a reduction rather than taking the full inflation increase. You take something less, but you only do it when you fail the test. Now, the test is a little counterintuitive. First of all, what you have to do is you have to calculate your current withdrawal rate. So you look at what a full inflation increase would be, and you say, okay, what would my withdrawal amount be? Divide that by my portfolio at the beginning of the year. That's my current withdrawal rate. Now, if that rate exceeds the target percentage, you failed. So it's a little counterintuitive. If your current withdrawal rate is lower than the target percentage, you pass. Okay, because that's a healthy portfolio. So if you pass, you can take the full increase. If you fail, you take some sort of reduction. And the purpose of the reduction is to bring the portfolio gradually back to a healthy state, to restore the survivability over the long term. So in my paper, I looked at reductions of 1, 2, 3, and 4%, and the full inflation increase. And one thing that I did with the target percentage is I never reduced the withdrawal below the amount that the retiree took in the previous year. So the idea here is that nobody likes a pay cut. Okay, my experience in working with retirees is that they don't necessarily need every year to take the inflation increase, but nobody really wants to take a withdrawal reduction. Again, each retiree is different. You have some retirees who the money is much more discretionary. Others, you're talking about food and medications.
Hey, Dave, we sent a chat message to this person typing in the background, but apparently they're not paying attention to their chat messages. So just want to make an announcement and have everyone ensure that their phone line is on mute so it doesn't affect the recording. Thanks. Sorry, Dave.
Okay, thanks, Dave. So and interesting enough, when I after I developed the target percentage and before I embarked on writing the paper, the first thing I did was I looked at the literature to see what other methods are out there because I wanted to address them in my paper. I found about 6 to 10 methods, and I eliminated most of them because most of them reduced withdrawal from one year to the next. And I, as a financial planner, I just don't see that I can sell that to my clients very easily. So that's the beauty of the target percentage, that it only reduces the inflation increase. It doesn't reduce the withdrawal amount from year to year. Okay, I'll tell you a little bit about my Monte Carlo simulation methodology before I show you the target percentage results. I use randomized capital market assumptions based on the Ibbotson historical data. As I showed you before, my portfolio was 35% large cap returns, 15% small cap returns, 50% intermediate term government bonds. I used CPI for inflation. I did annual rebalancing, and I did 50,000 iterations. Interesting enough, I like to think of the Monte Carlo simulations, the Monte Carlo method, as taking the Ibbotson data, the same data that Bengen used, and kind of putting it in a blender and smoothing it out so you can get these percentiles. I mean, when I went to write my paper, one thing that I felt that I didn't really want to do Monte Carlo simulation because it's a lot of work, but it was really the only way to show the granularity and to really measure the power of the technique. And again, in the simulations, the annual withdrawal is the prior withdrawal amount reduced, increased by inflation, subject to the target percentage. So here's the results of the Monte Carlo simulations for the target percentage adjustment. The first, the blue section, again, is the same as it was in before. A 3.9% withdrawal rate is a 95% confident with full CPI increases. If you look at the next section, if the retiree agrees to reduce their withdrawal increase by just 1% when they fail the target percentage test, they can increase their withdrawal, their initial withdrawal to 4.3%, which is a 10% increase. And over 30 years, they're only expected to lose 2% of their purchasing power. That's pretty dramatic, I think. And if they took a 2% target percentage over 30 years, they could increase their initial withdrawal by 18% with a 4% expected loss of purchasing power over 30 years. 3% is 4.9 with a 6% loss in purchasing power. And the full target percentage, no CPI increase in the bad years, is a 49% increase, 5.8% initial withdrawal rate with an expected loss of purchasing power of 17% in the 30th year. And that loss of purchasing power is expected to happen, over the 30-year period, so that it's the lowest at the 30-year period. Okay, there's the theory. Okay, now we're going to take it for a test drive. And to do my test drive, what I'm going to do is I'm going to go back to my sample set, and I'm going to look at 3 years. I'm going to look at 1969 because that's the worst. I'm going to look at 1938. I'm sorry, 1937 and 1938. Now, there are a couple of bad years next to 1969, but they look a lot like 1969. So I'm going to pick 1937, which is a little dipper there, and then I'm going to look at 1938, which is the next year. I'm going to use a little different target percentage than I used before, and this is the graphing I'm going to use. Okay, so I'm going to use a 5.5% initial withdrawal rate, and I'm assuming 7.2% returns, and that sustains my portfolio over 30 years. So the green line is the portfolio, and the scale is on the left. The red line is my withdrawal, and the scale is on the right. Okay. One thing that's interesting about this is you can see the portfolio, as we saw before, is expected to rise and then fall. The annual withdrawals are expected to gradually increase over time because this is theory. We've got everything is happening in a nice static world. And what I've done is I've created the scales so that the scale on the left is 10 times the scale on the right. So what that means is when the two lines cross, that's a 10% withdrawal rate. So you can see right about year 18, 19, the withdrawal rates, and this is my target. This is expected to go to 10%, and eventually portfolio is expected to go to 0 over 30 years. So now let's take this baby for a drive. Here's 1937. Okay, this is what would have happened if you started out with a 5.5% initial withdrawal rate. Now, we crash and burn at about 20 years, which we knew because 1937, I think the highest successful withdrawal rate was like 4.7 or something with this portfolio. And as you can see, we had a bad year in the first year, so the portfolio declined. And we had a few good years in the beginning of the 40s and started to come back. And then, but we had some inflation, and the red line goes up and can't sustain the portfolio over the 30-year period. So the next slide incorporates these two lines. I'm going to add a couple of thin lines. Okay, these thin lines are if you took the target percentage with 3% adjustment. And as you can see, when the portfolio went south, we started to take less than the full CPI increase. And the portfolio, the thin green line is the portfolio using the target percentage, and that sustains itself, and we end up the 30-year period with a little over $250,000. The withdrawals are not as much as the full CPI increase would have been. You can see right around the mid-40s, the thin red line flatlines, and what's going on there is we've got a period of inflation, but the inflation is less than 3%, but the target percentage is not reducing it below the previous. So the target percentage is, since the CPI increase is less than 3%, we're taking 0 increase. So that's the way that works. Now I'm going to add one more line in here just to point of reference. This is what a 4% full CPI adjusted withdrawal would have looked like. So you can see that by starting with 5.5% and taking a 3% TPA adjustment, we're actually going to end up taking crossing lines with that 4% line at about the midpoint. But we're still going to take probably more dollars out of the portfolio than we would have, but we're just going to take them in the early years rather than the later years. And keep in mind, this is a worst-case scenario, okay? This is what happens in a worst case. In most scenarios, you're going to do way better than this. I'm going to show you that in a minute. In fact, I'll show you that right now. This is 1938. So now this is kind of interesting. So this is the same 29 years, except we got rid of that first bad year in 1937, and we tacked on another year at the end. And this portfolio has no problem. So this shows you a couple things. Well, first of all, I'll tell you right now, it's a little misleading in the sense that, you know, if somebody decided not to retire in 1937 and retired in 1938, they probably wouldn't still have $1 million because they would have experienced the bad returns of 1937. But that's not the point here. The point here is that sequence risk is important. That if you have a bad year in your first year, it can ruin your whole retirement. And this is a perfect example because it's got 29 years, identical returns. Okay, so just for fun, we looked at the target percentage, and you went along fine in the early years, and then the portfolio went down in the early 40s, so you kicked in a little target percentage, portfolio recovered, and you stopped taking the target percentage adjustment, and you just took your full CPI increase. And then I'll add the little blue line. That's what 4% would have looked like. So you're going to take way more than 4% ever would have looked like. And keep in mind that, you know, I've got this set on autopilot because that's the way this works. So, I mean, by the time you got into your 15 years worth of retirement, you would have seen that you're way better than target, and you could have even increased your withdrawals if you wanted to. And this is more of an average year. So again, I want to reinforce that I'm looking at when I look at 1937 and 1969, I'm looking at the worst case scenario, which is what safe withdrawal rates is all about. Okay, here's 1969. It's a little different. Here we have the big inflationary years of the 70s and 80s, which is why that red line is so steep. But again, same thing. 69, 70 were not good years in the markets, and with inflation, we're crash and burn at about 18 years or so. This is what would look like with 3% target percentage adjustment. So we would have sustained the portfolio over 30 years, and we would have ended 30 years with $1 million, about the same we started with. Pretty dramatic difference. Now, well, we would have sacrificed a lot of inflation increases, and whether we could have afforded to do that, I guess that's another story. But again, we would have had the flexibility for mid-course corrections. I mean, that's the idea of a dynamic withdrawal strategy, that you have that flexibility to make those changes as time goes on. And this is what 4% would have looked like, full 4% increase. Now I want to really push it, and here's the 6% withdrawal rate. So we've got 6% withdrawal, pretty similar, little crash and burn a couple years earlier. This is 1937 with a 6% withdrawal rate. And I'm going to take the full CPI target percentage adjustment. And we see that it ends up a success, but, you know, we did take a little bit of purchasing power loss there, quite a bit. Here's what your 4% number would have been with full CPI. Here's 1938. Not as good as a 5.5%, but still you would have ended your 30-year with a full. You would have been able to take the 6% full CPI the whole period, and still ended with over $600,000 in your portfolio after 30 years. This is what the target percentage would have looked like. Looks like we would have failed our target in the early 40s, but we would have recovered and continued on. And this is what 4% would have looked like. Now we'll look at 1969 with a full CPI, 6% withdrawals. And again, you would, the portfolio would have been well over $2 million at the end. So, but you're taking a lot of purchasing power loss here. You probably would have made a mid-course correction somewhere along the lines, and not, and when you would have seen your portfolio doing all that well. And this is what your 4% line would look like. So, what are the conclusions? Target percentage is a simple yet robust benchmark that serves as a glide path to monitor portfolio health during retirement. Planners and clients can increase the safe withdrawal rates from the numbers shown in the research by 40 to 50%, as long as inflation increases are skipped when the target percentage is exceeded. I accomplished this by shifting the conservatism from the risk of failure to the risk of loss of purchasing power. So 5.6 to 6% is the new 4%. If you're persuaded by the current research that 4% is no longer safe, well then 4.2% to 4.5% is the new 3%. And now I'm ready for questions.
Dave, I'm not sure what graph this is on, but someone in the audience had asked, is the 7.2% expected return, is that at an allocation of 50-50? And they were wondering if that was too aggressive.
The 7 point, the 7 point, I can get to that. Hang on a sec. Oops. The 7.2%, yes. No, it's not the 50-50. It's the 35-15-50.
Gotcha.
And that is the rate that's sustained over 30 years. Assuming 5.5% initial withdrawal, 3% inflation.
Gotcha. So this time, people can either unmute their lines or send a question via chat to the moderator, which will get to me, but it might be easier just to unmute your lines and speak freely. While we're waiting for people to formulate their questions, and then say, Dave, thanks again for going through this. And one thing that you mentioned was that in a bad year, if you have a bad year in your first year of retirement, it can ruin someone's retirement. And what implications does that have for the asset allocation going into retirement and into and it may be a little off topic, but just want to throw that out there for people who might be interested in hearing.
Yeah. Well, I think that my understanding of the research is that there's a sweet spot in the asset allocation of 50-50, 60-40 for safe withdrawal rates, so my understanding is that studies have shown that people that use kind of the conventional wisdom of reducing your withdrawal rate as you get older, those reduce the chance of success. So the chance of success is optimized if you keep that's my understanding, if you keep the asset allocation in that sweet spot, no matter what happens to your portfolio. I mean, assuming that your withdrawal rate is a rate that's not too high, a rate that will be sustained over the remaining time period.
Right.
Or expected to, at least.
Are there any other questions for Dave?
No questions, huh?
Dave, we have plenty. You've left them speechless. Is there anything else in your appendix that you want to touch on that might help clarify things while people might formulate some questions? I know you included some different stuff.
No, I don't really have anything.
Okay, now let me ask a practical question. Probably a lot of people out there, they saw a lot of numbers, they saw some graphs, and now they're saying, well, hey, how do I go about creating this target percentage and implementing this for a client's portfolio? Dave made it all look so easy, but how do I, as a financial advisor, implement this? What would you have to say?
Yeah, that's a very good question. I mean, keep in mind that this is kind of a long-term proposition. Let me see if I can. Yeah, as you can see, that when a person starts out retirement, the withdrawal rate doesn't increase. The target withdrawal rate doesn't increase very quickly. It gets ahead of steam later on in retirement. And in terms of practical implication, I'm not sure. I haven't really come up with kind of a workbook for it. I have kind of an intuitive sense of it for myself as to what I think is safe, just because I've been doing all these studies. That's kind of a hard thing to say. I mean, basically, I think you need to look at what your current withdrawal rate is, what your time frame is, and if it's within your targets, you're okay. If it starts to move up, one thing that I should say is that the one thing that you learn doing this work is that small differences over many years make big differences later. That's really kind of the moral of the story. So those little target percentage adjustments that keep the portfolio safe really work over long periods of time. Maybe I would talk a little bit about the current research and the why I disagree with those assumptions. Basically, I don't think that I think that the assumptions that they used in that article that I mentioned are extremely pessimistic. They're saying that a 4% withdrawal rate going forward is 50% success rate. I think that's extremely pessimistic. Certainly looking at the history, it's extremely pessimistic. I mean, if you look at, then they're saying it's because we're in a low-yield environment. Well, the fact of the matter is that the 1930s were a low-yield environment in the same sense that today is. And that data set is included in this data set. Also, there's an article that just came out on the New York Federal Reserve website by two economists, and they're saying that the low yields are generating high equity premiums. Now that whole research that's arguing that 4% is not safe is using very low equity returns. They're using low equity returns for a couple of reasons. Number one, they're saying that bond returns are about 2.5% lower than they have been historically, and they're adding to that the historical equity premium. So they're basically suppressing nominal equity returns by the difference in the bond returns, which I don't agree with. I'm not sure what they don't provide a great basis for that. I didn't see one. Also, there's an article. Some of the other research, Kitsis in particular, uses the Case-Shiller PE10 or CAPE, Capital Cyclically Adjusted Price Earnings Ratio. There's an interesting article that you might want to Google. It's called, it's a very short, succinct article. It's called "The Case-Shiller CAPE is Obsolete," at least for now, I think it's called. And basically what it shows is that because the CAPE is a 10-year 10-year average, and because it includes some wild years like 2009, around there, where price earnings ratios were many times what they normally are, the CAPE benchmark is overstated by 25-35%. And this is what a lot of the research is on, saying that we have high equity valuations and therefore we're going to have low equity returns in the future. So that's why I say that the assumptions underlying the pessimists, I have challenges.
Hey, Dave, we've had a few questions come in.
Sure.
Someone had mentioned or requested if you could show how to use the TPA table with a real client scenario. I don't know if you have that set up for right now, but that was thrown out there.
Well, keep in mind it's a long-term thing, you know. So I mean, we got the screen here. So in the first year, if you're going to say, okay, I have a client with $1 million, I'm going to withdraw 4%. Okay, so that's the first year. You really don't use the target percentage in the first year. So then in the second year, if you want to take the full inflation increase, you want to take $41,200. You want to look at what is in their portfolio, which is not going to be $1,018,560 because that's just a theoretical number. You're going to have a real number there. So you take the $41,200, you divide it by what's ever in your portfolio. That tells you what your current withdrawal rate is, or I guess you would call it your preliminary withdrawal rate. You look at your target percentage, and you see if your current withdrawal rate exceeds 4.04%, then you don't take the full $41,200. You take something less because you're below. You've exceeded your target.
That's where you either reduce that by 1, 2, 3, or 4%, whatever that may be, right?
Right. If your current withdrawal rate is below 4.04%, then you're good to take the full inflation increase if that's what you want. And then you do that each year.
So it's not a set it and forget it. It's one that the advisor has to monitor, or
right. It's an
advisor
annual,
client. Yeah, it's an annual thing,
yeah.
which is consistent with a long-term relationship that a client would have with an advisor, which is good.
Right. And like it's like any financial plan. You stick with the plan until you figure out a better plan, and you're free to change plans or adjust your plans as time goes on. But the best strategy is to pick a plan and stick with it, unless you have a good reason to change.
And at the beginning, they just need to have these percentages set up. But then the actual, I guess that's getting to the individual's question, is like, I guess what you just described is what he wanted to see on paper, or maybe on the screen, of if those withdrawals deviate from how it compares to the target percentage and what you would do. So I think you did a good job explaining that. And if not, we can definitely have that.
Next time I'll add a slide with the math on that a little bit.
Yeah. Another person had asked, have you experimented with the bond ladder?
That sounds like an ACA question.
I was just going to say that, Dave.
Yeah.
I can let you guess who it was. No,
yeah, I see the bond ladder as something separate and distinct from this. I see the bond ladder. It's kind of in between. I mean, the bond ladder is an asset allocation strategy, and it's sort of a withdrawal strategy, but it's sort of something in between. It is I look at this as just another metric. I like the bond ladder. I use the bond ladder. And for those of you who don't know what the bond ladder is, I think in the context of most people in the investment world, the bond ladder is a little different beast than what in the Alliance of Cambridge Advisors, what we call the bond ladder. In the traditional sense, a bond ladder would be 5-year bond ladder, 5 or 10-year ladder of bonds with coupons. When the oldest one matures, I'm sorry, when the shortest one matures, you buy at the long end and you perpetuate the ladder that way. That's not the ACA bond ladder. The ACA bond ladder is a ladder of zero coupon bonds that mature in the year you want to spend them, it's more of an investing strategy, I think, than a withdrawal strategy. This is a little different piece.
Dave, here's another question going at it from a different angle. It said, for those who retired in 1937, they obviously didn't live as long in retirement, so maybe a shorter longevity wasn't as big of an issue. But more recently, with longevity being the way it is, how do you handle longevity risk? I know you're talking about 30 years, but what about for the person who maybe fears they might live 40 years or 45 years or longer in retirement?
Yeah.
How do you address something like that?
This really doesn't. The only way this addresses longevity risk is that you pick your time horizon, and you run with it. All I can say to that is that with the safe withdrawal framework, the idea is that in most cases you're going to end up with multiples of your portfolio at the end of the time horizon. It's only in the worst case scenario that you run out of money, and that's like a 5% probability. You could address the longevity issue and with immediate annuities, deferred annuities with index inflation, tips, this kind of thing. But you're giving away your equity premium, which is the engine that drives your portfolio and gives you the upside. I think it would be interesting. I'd like to see somebody do good studies on that. I'm not sure I've run across one that really impressed me that way.
Good deal. Someone else had asked, going back to the 50-50 versus the 60-40, would these percentages need to be reduced if you have a 60-40 portfolio? Did you run any scenarios with the 60-40 portfolio?
I did not. The purpose of the paper was to, illustrate, test, and the technique. And for that, I wanted a constant asset allocation, a single asset allocation. Other papers have addressed that, and I think they generally show that your chance of success increases with a 60-40 portfolio. My experience, though, is that for a lot of my clients, it's kind of a stretch to get them to 50-50. 60-40 is a little too much. I'm not sure they want to take that kind of risk.
Right. It kind of exposes them to too much risk in those early years of retirement.
Yeah, they just have an instinctual sense that they don't want to go there. That's my experience. I don't know what other people have.
Now, one of the things you kind of touched on in the article, Dave, was you kind of compared your results versus some of like Guyton's modified rule and other ones. And I know you didn't really touch on it in this webinar, but do you want to summarize how some of your results compared to others like Guyton's or Blanchett and Frank?
Yeah, well, Guyton was kind of the pioneer in the adaptive withdrawal strategy, dynamic withdrawal strategy, and he got a lot of good response to his technique. Although it clearly the target percentage technique is far superior of a metric and a technique, and that's just shown in the article. The other method, the Blanchett and Frank lookup table method, was a very good method. Although it was very complicated to deploy because you had to do hundreds of Monte Carlo simulations every year well, at the beginning at least, until you changed your assumptions, and then use that like a table lookup to determine whether or not to take the inflation increase. And what I showed in the article, the people who read it, was that once you run that table, you can just distill the Blanchett and Frank technique into a set of targets, and it becomes the target percentage method. So the target percentage method it's kind of like one instance of the target percentage method.
Good deal, Dave. We had another question come in. It says the TPA reduction refers to the relative reduction in CPI. Is that correct? And so if the CPI is 3%, a 1% reduction yields a 2.97 adjustment. And is that correct?
No. No. Actually, that's
the actual withdrawal amount.
That's kind of a third way of looking at it. My original concept was that if the CPI went up 1% and you were going to take a 1% target percentage adjustment, that instead of taking 3% increase, you take 2% increase. That's not the way I wrote the article, and the reason is that that's not the way the Blanchett and Frank did their technique, and I wanted to be apples and apples and not have to explain the differences between two techniques. So the way I ended up doing it was the Blanchett way, which is so for a 1% target percentage adjustment, I took a 3% increase of last year's amount, so that's 103%, and I multiplied that by 99%. So that's a 1. So in other words, I reduced the gross after CPI increase amount by the 1, 2, or 3, or 4%. And that's very close to 2%. It's like 1.98% or something like that increase.
Perfect. I hope that explains better.
And that's explained in the article.
Yeah, and I would encourage people to read the article. Dave, can you, this is out on the FPA website, right, in the archives?
Yes.
Okay.
Yes. In fact, if you just, if you Google my last name, Zolt, and higher safe withdrawal, it should be the first link.
And Dave, just to kind of wrap up, I don't see other questions coming in, but they might as we're talking. I just want to give a couple more minutes for people to chime in. Can you go back to, and we did get a question just now, could you go back to the chart, one of your charts, and just explain to people what those lines are, just in case somebody joined late or they didn't understand or follow your different, the 5 lines you had on the...
Sure. Let's take the first one. Yeah, so, well, basically, I try to, it's kind of easy to show this as an animation. This is, the green line is the portfolio, the red line is the withdrawal. The scale for the green line is on the left, the scale for the red line is on the right.
And this is just starting with the 5.5% initial withdrawal and
right.
increasing it by the 3% inflation.
Right.
Well, this is what
not 3%. No, actual CPI.
Oh, I'm sorry. Yeah, actual CPI, whatever
actual
inflation
CPI.
is.
Yeah, so that's why you can see the red line is jagged.
Correct.
Okay, and actual returns. That's why you can see the portfolio. The green line is jagged, and we start out at $55,000 withdrawal. It goes up a little. It goes down a little for deflation. Actually, a little bit. You can see that in the late 30s, early 40s. And then the portfolio eventually, declines to 0 at about 1958 or so, and that's when the withdrawals stop. So then I added the 2 thin lines next to show both the portfolio, still green, and the withdrawals, still red, but with the TPA 3% TPA adjustment deployed. And you can see that it sustains the portfolio over the 30-year period with reduced withdrawals. Well, not reduced withdrawals, but lower withdrawals.
But at least they have withdrawals to take.
Right. The full CPI increase, right.
Yeah.
Right. And then the last set of the triad, I guess you could say, of these charts, graphs, is what just the old-fashioned Bengen 4% withdrawals would have looked like. I don't show the portfolio on that one because I'm just trying to contrast them to the withdrawal side of the chart.
That's great. We had one other question come in. There may be others. Is there any study on retirees decreasing spending in the later years of their life?
Yeah, those articles are cited at the beginning of my paper.
Okay.
There's 2 articles in there. Pretty thorough.
Good deal. Well, unless we have any other questions that people can unmute or send them via chat. Dave, I want to thank you for your time, and I appreciate you, everyone attending the webinar. And look for Dave's paper. They can search his last name and what was the
higher safe withdrawal rate.
Higher safe withdrawal rate, and then a recording, a link to the recording to this presentation will be sent out, along with some other information to those who attended or registered for the webinar. So let's see. I don't think we have any other questions. So Dave, thanks again.
Okay.
And everyone have a great day. And our next CFA call for this committee will be in, I believe, August. So thanks again, Dave.
Okay, thanks.
Good afternoon, everyone. Bye.